Welcome to the Deep Dive. We're the show where we really dig into complex topics, pull out what you need to know, and hopefully leave you feeling, well, truly informed.
That's the goal.
And today we're tackling a number that, honestly, it's just staggering. Since the start of 2023, over 500,000 tech workers have been laid off.
500,000, it's huge.
Right. And I bet, like most people, you probably have some quick ideas about why that happened.
Oh yeah, the usual suspects immediately come to mind. You know, the end of the whole pandemic hiring frenzy, maybe.
Or companies just realizing they overhired.
Exactly. Or some people point to AI, thinking it's already taking jobs, or maybe, blaming H-1B workers.
And sure, things like the end of zero interest rate policy, ZRRP, that definitely had an effect. Higher borrowing costs slowed down VC money for new startups.
Right. ZRRP hit new company formation more than it forced established giants into immediate massive layoffs. It wasn't the direct trigger for those big layoff numbers we saw.
Okay, so if it wasn't really those common explanations driving the bulk of these layoffs, especially at the big established companies, what did we find? What was the real immediate cause?
Well, this is where it gets pretty surprising, actually. When you follow the money, the evidence strongly points to something most people haven't heard much about.
Okay.
An often overlooked change to a specific tax rule, Section 174 of the Internal Revenue Code.
Section 174. Sounds dry, maybe a bit technical.
It does. Sounds like just some accounting detail.
Yeah.
But its real-world impact, absolutely massive. It seems to be the core bottom-line reason for a lot of this turmoil.
Interesting. So our mission for this deep dive then is to unpack that connection. We need to understand what Section 174 used to do.
How it got changed.
And what the maybe counterintuitive effects of that change have been on jobs, on innovation, and really on the whole U.S. economy.
Yeah, get ready, because this might shift how you think about economic policy and its sometimes unexpected consequences.
All right, let's dive in. Section 174, what is it fundamentally and how did it work for what? Decades before all this.
Okay, so Section 174, it's basically the part of the tax code that tells companies how to handle their spending on research and development R&D.
R&D.
And for almost 70 years, it was a massive boost for American innovation, kind of a hidden engine for economic growth.
A cornerstone, you said. So it provided a really significant benefit.
Absolutely. For roughly 7 decades, American companies could take 100% of their qualified R&D spending.
So salaries, software.
Exactly. Salaries for engineers, scientists, the software they use, even payments to contractors, as long as it was aimed at creating or improving a product. They could deduct all of that cost in the same year they spent the money, right off the top of their taxable income.
Wow. Okay. So immediate deduction. That sounds powerful.
It was incredibly powerful. This rule, it goes way back to 1954. It was a huge incentive. It basically allowed companies to manage their R&D costs against their income right away.
So the government was essentially saying, go innovate, and we'll make it easier on your taxes right now.
Precisely. The societal goal was pretty clear. Invest in R&D, grow the American economy. And it worked.
And the impact over those decades.
Well, think about the giants. Bell Labs back in the day, Microsoft, Apple, Google, Facebook, pretty much every major U.S. tech boom. This immediate deduction is widely seen as a key factor that helped foster their dominance.
Because it made it really attractive to pour money into R&D here in the U.S.
Exactly. It made the finances work. Now, technically, companies could choose to spread those costs out over time, capitalize and amortize them, but almost nobody did. Why would you? When you could get the full tax benefit immediately.
Right. The immediate write-off was just too good to pass up.
It offered flexibility and immediate cash flow benefits.
So if it was such a successful policy for so long, what on earth changed? This takes us to the turning point.
It does. The Tax Cuts and Jobs Act, the TCJA from 2017, major piece of legislation. And buried within it was this amendment to Section 174.
Okay, and this wasn't just a small tweak. When did this change actually kick in?
That's key. The law passed in 2017, but this specific change was delayed. It only took effect for tax years beginning after December 31st, 2021.
So starting in 2022, the rules of the game completely changed for companies doing R&D.
Completely. The TCJA got rid of that immediate deduction option. Gone.
So what do they have to do instead?
Now, R&D costs must be capitalized and amortized.
Right.
Spread out. For research done in the U.S., it's over 5 years.
5 years. Okay, that's different.
And for research done outside the U.S., it's over 15 years. 1 to 5. which is, let's just say, pretty untenable for planning.
15 years. Okay, explain what that actually means for a company's finances, their cash flows. This sounds technical, but the impact must be huge.
Oh, it's huge. Imagine, like, a company used to spend $1 million on R&D salaries and stuff, and they wrote off that whole million in year one. Taxable income reduced by $1 million. Now, under the new rule, in that first year, they can only deduct a small slice. Because of how amortization accounting works, it's effectively only about $100,000 for domestic R&D in year one.
Only 100,000 out of a million.
Right. The other $900,000 gets spread over the next 4.5 years. So suddenly, their taxable income for year one is much, much higher.
Even though they spend the same amount of money.
Exactly. They have to pay taxes now on money they already spent on research, money that might not generate revenue for years, if ever. It's like paying taxes on potential future profits that haven't happened yet. It creates this immediate cash crunch.
That sounds like a major short-term drag, as our analysis called it. A big hit to cash flow, especially for research-intensive companies.
Definitely. It significantly increases their tax liability right away.
Yeah.
And no, other tax credits, like the Section 41 R&D credit, they exist, but they work differently and aren't nearly as broad or as immediately useful as the old Section 174 deduction was. The bottom line, much bigger tax bills right now.
Okay, connect the dots for us then. How does this accounting change, Section 174, translate directly into, 500,000 people losing their tech jobs? Where's the direct line?
The direct line is cash flow. When companies suddenly couldn't deduct those huge R&D expenses immediately, their available cash got squeezed hard.
Especially hitting the smaller guys. Startups.
Particularly hard, yes. Startups, smaller tech firms, they often run lean, pouring everything into R&D. Suddenly, they're facing these massive, unexpected tax bills.
So they have a choice.
A terrible choice. Take out expensive loans, if they even can, cut costs drastically, or, face bankruptcy.
And layoffs are often the fastest way to cut costs.
Sadly, yes. For many, laying off engineers, researchers, developers became the quickest path to freeing up the cash needed just to pay the IRS.
That example from the sources was just brutal. A small company laying off a $200,000 a year engineer.
Just to cover a $189,000 tax bill that wouldn't have existed the year before.
That's not about performance, not about the market shifting. It's purely about needing cash for a tax bill caused by this rule change.
A direct consequence. It's a forced choice between keeping your talent, your innovation engine, and just surviving fiscally.
And what about the foreign research part? That 15-year amortization. Did that maybe bring jobs back to the U.S. like some might have hoped?
You'd think so, right? Make it less attractive to do R&D overseas, but no, that's where the policy seems to have really backfired.
How so?
It didn't bring jobs back. Instead, the bigger companies, the ones with global operations, they often just shifted R&D out of the U.S. to countries with more favorable tax rules.
So moving R&D to places where the tax laws were more like the old U.S. system.
Exactly. We saw reports, for example, of Google shifting some R&D work to Germany, Microsoft moving research functions to China. Why? Because those places might allow for quicker write-offs, closer to what the U.S. used to offer.
Wow. So the unintended outcome wasn't reshoring jobs, it was actually accelerating the offshoring of R&D and leading to layoffs for U.S.-based engineers.
That seems to be a major part of it. As one source put it, the policy is not working out how it was planned. It wasn't about competitiveness of the workers. It was about the tax treatment of their salaries and related costs.
Okay, this raises a huge question then. If the impact seems so, negative for U.S. innovation and jobs, why would Congress put this change in place, especially with that weird delay? It seems almost designed to fail.
Well, that takes us into the political maneuvering behind the TCJA. Back in 2017, it's kind of a classic case of gaming the system.
Gaming the system? How?
So the headline item of the TCJA was slashing the corporate tax rate.
Right.
From 35% down to 21%.
Right, a big cut.
Huge cut, which on paper meant a massive loss of government revenue. Now, to get the bill through the Senate under their budget rules, it needed to appear deficit neutral over a 10-year budget window.
Meaning the projected cost had to be offset somehow.
Exactly. So lawmakers needed to find ways to make up for that lost revenue, at least within that 10-year forecast.
And the Section 174 change was one of those ways.
It was a key part of the trick, let's call it. They included future tax hikes, like changing Section 174, but critically, they delayed when those hikes would actually start.
So delaying the pain until after the 10-year budget window closed. or at least until later in the window.
Precisely. By making the Section 174 change effective only starting in 2022, it wouldn't really hit the budget forecast significantly within that initial 10-year period used for scoring the bill. It kicked the fiscal impact down the road.
So they could claim the overall bill was paid for in the short term while scheduling this R&D tax hike for later.
That seems to be the strategy. The thinking might have been, let's get the rate cut now and we can do this R&D thing later. Maybe we'll repeal it before it even takes effect.
Nope. Despite expectations from many businesses and even some bipartisan support for keeping immediate R&D expensing, Congress didn't act. Inertia, political gridlock, who knows?
So when 2022 ended and companies started preparing their taxes in 2023, boom, reality hit. That delayed tax hike suddenly materialized as actual, much larger tax bills. It was a real shock for many businesses.
And that shock forced their hand on cost-cutting.
Absolutely, especially for smaller companies. We saw reports of small software firms facing, quote, extinction-level tax bills. Some said their taxable income tripled overnight just because of this rule change. That directly forced layoffs, salary cuts, survival mode.
And it wasn't just small firms feeling the pain.
No, the big players, too. Amazon, Meta, Alphabet, Google's parent, Microsoft, Salesforce, they all had significant U.S. layoffs. And importantly, as we discussed, they also shifted jobs overseas. Think Twilio cutting 22% domestically, Shopify cutting 30% and moving U.S. R&D, Coinbase cutting 36%. It was widespread.
Now, we should be clear here. 2023 had other economic headwinds.
Right.
Interest rates were up, VC funding was drying up, supply chains were still messy, maybe some pandemic overhiring corrections.
For sure, it wasn't happening in a vacuum. All those factors definitely added pressure.
But the argument is that Section 174 was a major, perhaps the major immediate trigger.
Yes. Our analysis suggests that while it wasn't the only cause, the Section 174 change definitely drove or accelerated layoffs that otherwise would probably have been unnecessary. It poured fuel on the fire, or maybe even started the fire for some companies.
And you mentioned earlier, this isn't just a tech problem. How broad was the impact of this old R&D deduction?
That's a really crucial point. From 1954 right up until 2022, that tax rule encouraged basically all kinds of businesses to act a bit like tech companies.
Meaning investing heavily in research development software.
Exactly. Think about retailers developing custom logistics software, or healthcare companies building internal data analysis tools, or media firms creating new digital platforms. If they invested in creating or improving products or internal systems using software development or research,
they could write off those costs immediately.
Right. It incentivized building things in-house, customizing software, innovating across the board, not just in Silicon Valley. OECD research backs this up. Immediate deductions spur more innovation than spreading them out.
Do we have a sense of the scale? How much R&D was happening outside traditional tech?
Well, get this. Government data showed U.S. businesses reported around $500 billion in R&D spending back in 2019, and almost half of that came from industries outside what you typically call tech.
Half, wow.
Yeah. Manufacturing, healthcare, finance, retail, you name it. The whole digital economy driven by this kind of R&D makes up maybe 10–20% of U.S. GDP, and that doesn't even count all the downstream effects jobs for realtors, restaurants, childcare supporting those workers. This change introduced friction into a huge slice of the economy.
It sounds like a lot of companies, especially digital-first ones, built their whole financial model around this R&D deduction. There was this phrase, synthetic, carefully engineered break-even.
Yeah, that captures it well. The idea was you spend aggressively on R&D engineers, software, etc. You expense it all immediately under the old Section 174 rules.
Okay.
This keeps your taxable income close to zero or even negative. So you might report a loss to investors, which is normal for companies focused on growth, but you owe very little or nothing to the IRS.
Because the R&D spending shielded the income. The model was based on it costs a lot to invent the future.
Exactly. Invest heavily now, reap rewards later, and the tax code supports that investment up front.
But the Section 174 change just completely blew up that model. It cratered it.
Completely cratered it. Suddenly, you can't expense all that R&D immediately. You have to spread it out over 5 or 15 years.
So the tax shield disappears.
Vanished. Now, these companies, even if they're still burning through cash investing heavily, they suddenly look profitable on their tax returns.
Because the expenses they actually incurred are no longer fully deductible that year.
Right. Leading to, as the analysis put it, real tax bills on imaginary gains. They owe taxes on profits that only exist because the tax rules changed, not because their underlying business suddenly became more profitable.
And for public companies, facing those unexpected tax bills, What's the ripple effect?
Management has to react. They need cash for the taxes, and they need to protect profit margins to keep shareholders happy and the stock price stable. So what do they cut?
Capital expenditures, hiring freezes.
Yep. CapEx, like spending on data centers, equipment, and of course layoffs. Cutting headcount is often the fastest way to preserve those margins in the short term.
Even if it hurts long-term innovation and growth.
That's the trade-off they were forced into. A choice between short-term financial appearances driven by a tax change and continuing the long-term investment strategy they previously followed.
Okay, so let's try and wrap this up. The big takeaway here seems to be that a change buried in a tax law, delayed for political budget reasons,
Ended up having this incredibly disruptive, immediate, and very widespread negative impact on American jobs, particularly in innovative sectors, but really across the economy, far beyond just big tech.
Yeah. And understanding this one sort of obscure detail, Section 174, it really changes how you look at the economy, doesn't it? And how policy decisions play out in the real world.
Absolutely. It helps you, the listener, get beyond the surface-level explanations and see the deeper mechanics at work. It's about being truly informed.
So here's maybe a provocative thought to leave you with. When the legislative process focuses more on hitting budget targets in a 10-year window than on the immediate real-world economic impact, what's the actual long-term cost?
Right. What's the cost to innovation, to job creation, to our competitiveness globally? And maybe how do we make sure that policies designed to, balance the books don't accidentally undermine the very economic growth that those budgets depend on?
Something to think about. We definitely encourage you to keep digging into how these seemingly small policy details can have such huge consequences.
Keep asking those deeper questions.
Thanks for joining us on The Deep Dive. We'll catch you next time.